Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Tim Kramer, CEO of CNIC Funds, to discuss the electronification of America and related investment opportunities. Tim, it's great to have you with us. Welcome to TradeTalks.
Jill, thanks for having me. Appreciate the opportunity.
You got it. As the U.S. targets 80% renewable generation by 2030 and a goal of becoming 100% carbon free, the shift is really focusing towards renewable energy in a major way. But you say the data is not straightforward, that the electricity in the U.S. is massively understated. Tell us more about that.
Sure. So if you take a look at, first of all, the demand, right? Every time you pick up the newspaper, you see increases in the demand that aren't usually picked up in the typical supply demand reports. So the first one you talk about is electric vehicles. So by 2030, the U.S. has a goal of having like 54% of all of its vehicles be electric engines, not combustion engines for the new ones. But the auto manufacturers have a goal to have that much higher by that time period. There was an article the other day in the Wall Street Journal that talked about California tightening their emission standards so that Jeeps wouldn't even be eligible because of the emission standards by 2026. So there's one example of where we think you're going to have a higher electrification in terms of just vehicles. The second thing would be every time you pick up the paper, take a look at a few weeks ago, there was New York Times, no gas stoves in New York anymore. After that, there was the Colorado River drying up, and they're talking about rationing water. Well, there's 7 million people that rely on hydroelectric power there. You take a look at the data centers in Texas. Right now, they're like 2% maybe of what the peak load is. And the projections are for those data centers, because of cloud computing, other things, for those numbers to be as high as like 30 or 40% by 2030. So we just think that from a demand standpoint, even if you take a look at like weather normalized demand, so weather is, just kind of make it what it should be on average, you're still seeing an increase in what that demand is. So we think that the absolute demand itself is understated, and we think the supply is overstated. So what happens is most of the regions in the country, they'll talk about what their reserve margins are, or like how much excess power they should have. But as you start to retire all of this fossil generation because it's no longer economic or because of the rules, you're trying to replace that with all these renewables. But the development queue for renewables is so backlogged that you're just not going to meet these targets. So like you said, 85% renewable by 2030. If everything in the development queue that's currently in there gets built and gets built on time, you're like 57% renewable. So you're not there yet. So we think that because of what you've got for this, supply understatement, the demand not being stated correctly either, that you just have this, in essence, a really interesting situation that develops here.
Tim, do you think that these targets are achievable? And then the second part to my question is, it's expensive to have everything generated by, electrical sources. I mean, especially when you think about EVs, not everyone can afford to get an EV. Will there be enough scalability here for it to be affordable for consumers? And are these targets really achievable?
Very ambitious goals. There's no doubt about that. And there are some log jams in terms of just the supply in the raw materials, in terms of the batteries that you need and the metals that go into that, in terms of, the workforce that you need in order to get these things constructed. So there's a lot of headwind to get this done. It's not government headwind. They're trying to provide all the incentives possible. But in terms of just the actual physics of getting these things on the grid, yeah, it's going to be challenging.
So why should people want exposure to electricity as an investment? And is there an ETF to buy this? What does the investment vehicle look like?
Sure. So why you should want exposure is on a retail notional basis, the most consumed commodity in the U.S. is electricity. But up recently, it wasn't in any index, any ETF, no mutual fund, nothing. So what we did is we partnered with ICE, the Intercontinental Exchange, and we published an electricity index at the beginning of this year. And then we co-branded an ETF that is benchmarked to that index. So it allows you a chance to express your view on this particular product.
And what should it replace in a portfolio?
So if you take a look at traditional portfolio allocations, if you are like a pension or an endowment, they typically like to hold commodities for inflation protection and portfolio diversification. So if you take a look at CPI, just month after month after month, it's right there. Electricity is 2.5%, kind of like plus or minus 0.1%. It's 2.5% of the CPI. So if you want inflation protection, you should definitely be taking a look at that. Also, traditional portfolio theory says that you should have somewhere between 5 to 15% of your portfolio allocated to commodities, and that's for inflation protection and portfolio diversification. If you take a look at what the top 25 pensions and endowments are holding right now, it's kind of dialed down to about the 3 to 5% range of that. But the way they express that right now is via traditional commodity indices, which hold, all sorts of commodities, including energy, but they don't have the most relevant commodity, which is electricity. So there's another case where you can make a very good argument for this index is very timely.
All right, Tim, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me. Appreciate it.